south side of Chicago is the baddest part of town. And if you go down there, you better just beware of stupid girl. Stupid girl.
Wonder if you think we can inflate the Dow Jones a little bit more? I'm wondering, yeah. I'm wondering if we could. What am I doing? I can't read. What the heck? I'm faking it, just like presidency. People who have low self-esteem, so they come on YouTube 24 hours a day to brag about how successful they are. And gentlemen, if you've watched the non-Dr. mccainisthroughx's videos as I have, you've noticed a trend. Most of her singular videos are cut and paste. Most of them feature the estrogen-deprived Rachel Maddow or the obese Ed Schultz or some other goofy-looking talking head from PMSNBC plunking down that video on her channel after copying it and pretending to be smart. This particular video, she didn't do that. Instead, we're subjected to a litany of screenshots showing the Dow continuing its inflation-induced cheap credit Federal Reserve spike and acting as if that proves Hussein is a great POTUS. No mention is made of anything Congress did, as Congress holds the purse strings, but that shouldn't surprise you. Old fossils like mccainisthroughx and old fart rants don't understand basic civics. The Dow Jones, as you will learn, is not a good barometer of the health of the overall economy. mcstupidx might think it is, but intelligent economists know otherwise. mcstupidx will probably recycle this sort of vid in a few months or so, as she's had quite a fetish for the Dow Jones in the past, and I've corrected her, singular, on that before. See the video on your screen. She leaves a lot of information out, such as the 4 years of the Dow under Jimmy Carter. Even with inflation running wild, Carter's Dow tenure was not good, despite the capital gains rate being higher today than it is now under Hussein Obama. mcstupidx leaves out a lot of pertinent data, but that's what I'm here to do, correct her singular misconceptions. She's not going to attempt to talk about the economy en masse, and if she does, I will recycle my previous responses to her, which will just make her pound the table, as she did prior to the 2012 election, because I already slapped her down on that. See the video on your screen now. Been there, done that, McStupid. So mcstupidx is going all in, tossing in all her singular chips on the Dow Jones. Let's go back to my previous slapdown of mcstupidx and look at how those economic indicators have fared since the last time I slapped her down. Number of those unemployed for 27 weeks or more averaged 4.967 million fiscal years 2009 and 2010. It was 5.78 million fiscal years 2011 and 2012. That was right before the 2012 election, when mcstupidx was talking up the economy. Doesn't look too good, does it? If anyone else, if someone with the last name Bush had been president, it would have been a terrible economy. And mcstupidx would have got her talking points from Think Progress on that. Number unemployed for 27 weeks or more for fiscal year 2013 was 4.522 million. Ignore my typo, it was 4.522 million. There was improvement, but considering all the Keynesian deficit spending that was implemented, I'd say the so-called Keynesian multiplier isn't what mcstupidx and her sheep think it is. Average weeks unemployed remains high, averaging 26.9 weeks fiscal years 2009 and 10, 38.8 weeks the next two fiscal years, and 37.2 weeks in fiscal year 2013. Still well above the fiscal year 2009-2010 average, which doesn't look good for Hussein. mccainisthroughx doesn't even know about this, and if she did, she wouldn't cover it. But her cut and paste sources aren't very detailed, so she is rather clueless. Median weeks unemployed, as you can see from the actual data, remains high, averaging 17.15 weeks in fiscal years 2009 and 10, 20.6 weeks in fiscal years 2011 and 12, and 17.27 weeks in fiscal year 2013, higher than in the 2009-2010 average. Median weeks unemployed, as you can see from the actual data, remains high, averaging 17.15 weeks in fiscal year 2009 and 10, 20.6 weeks in fiscal years 2011 and 12, and 17.27 weeks in fiscal year 2013. Still not looking good for Hussein, which is why mccainisthroughx is obsessed with the Dow Jones. It's generalized, it's short, and it's easy, and of course she won't debate anyone on this subject in detail. Go to her channel and try to do it. She will throw a fit. But if you come to my channel and debate me, I will record your comments. The U6 unemployment rate. The real unemployment rate has significantly declined from a 16% average in fiscal years 2009 and 2010 to 15.6% in fiscal years 2011 and 12 to 14.05% in fiscal year 2013. However, Hussein and his Congresses are going to accumulate far more debt than Bush and his Congress. In fact, debt per capita, as you'll see, Hussein and his Congresses have accumulated more in just 4 full fiscal years than Reagan did in his Congresses in 8 fiscal years. Oh my gosh. Government payrolls aren't exactly cratering either, and Washington continues to allow states, some worse than others, to feed off the federal trough. All this and we get a 14% unemployment rate? And McStupid thinks Bush had a bad economy. Now we're going to shift gears briefly to the bloated disability rolls. See the 2 videos coming up on your screen for that. I've already covered it. And the ever-falling labor force participation rate, as I covered in those 2 videos already. So I can refrain from repeating myself. The disability rolls are on a tear, and over half of those on it are therefore mood disorders, bipolar, crap like that, which I admit a lot of progressives have. They do have numerous issues, and musculoskeletal problems. Hussein and his ilk, many of them Republicans, have been more than happy to promise folks generous taxpayer-funded benefits. Just vote for me. Got bipolar disorder? We'll pay you not to work. See those previous 2 videos where I covered that in detail. Something mccainisthroughx and her ilk do not do. Now let's focus on briefly the labor force participation rate for men specifically. Men aged 25 to 54 and then men 25 to 34 specifically. The labor force participation rate for men began a very slow and very gradual decline in the 1950s and 1960s. However, it averaged well above 97% during the 1950s. Men were working. They weren't drawing taxpayer-funded benefits because they became raging alcoholics, nor were a large segment of them having droves of children out of wedlock they refused to take care of, demanding the taxpayer do it for them. In the 1960s, it remained high, slowly declining, but still well above 96%. Men aged 25 to 54 were working. They were made for work, and they did so to support their families. During the 1970s, the decline accelerated, and during the 1980s, the decline continued, but wasn't as pronounced as the previous decade. Again, I've got the data. The average labor force participation rate for men 25 to 54 during the 1980s was 93.8%. Then, beginning in the 1990s, the decline accelerated, as you can readily see. That acceleration has continued to increase into the Hussein-Obama regime. 88.425% is the average labor force participation rate for men 25 to 54, calendar years 2010 through 2013. Wow, if Hussein Obama and his cronies can get 10 million or more on the disability rolls, we'll have full employment. And those folks are not counted against the unemployment rate. Very valid point, salient point I have to make there. Some of that decline for men can be attributed to women beginning to enter the workforce in droves in the 1960s, but it doesn't explain the rapid and continuing drop that began in the 1990s. The number of years when the labor force participation rate declined for men aged 25 to 54, as well as declined by more than 0.3%, has accelerated since 1990. Washington has an agenda to buy votes with other people's money and to redistribute income. Back in the 1950s, Washington wasn't redistributing the trillions they are now yearly. This is a disturbing trend unless you're a well-connected Washington politician or a crony or lobbyist. Then you're probably doing well with someone else's money. We are in serious trouble, folks. No wonder mccainisthroughx is crowing about the Dow Jones. She doesn't know much. The data I've covered here speaks volumes. For men aged 25 to 34, young men in their physical prime, the trend is also disturbing. During the 1950s and 1960s, men aged 25 to 34 had a labor force participation rate well above 96%. Keep in mind these folks were at least 3 decades from retirement. If they exit the workforce, that's a long time to be their caretaker prior to retirement. From 2000 to present, the labor force participation rate for men aged 25 to 34 has cratered to under 93%. It's headed down, it's headed below the 89% mark. As you can see, we have a sizable number of folks who are less than 40 years old, not in the labor force. Again, Hussein's flaccid economy would be even worse if it weren't for a continuation of and an acceleration of people dropping out of the labor force. This is why mccainisthroughx does simplistic, generalized videos. She doesn't know much, and she wants you to remain ignorant too. I think this will be a good time to shift gears back to the Dow Jones specifically, and I think Professor Jeffrey Herbener explains it better than anyone else could, making numerous salient points about the Dow Jones highs and lows, as well as a good point about why many of those downturns occurred. He also covers previous large Dow increases and decreases and how the general economy fared out after that, as well as the impetus for those increases or decreases. mccainisthroughx spent a few hours on Google learning her info. This man has dedicated his life to studying it. Who has more credence, a janitor or a professor who has literally spent decades learning this information? I'm going to post a 9+ minute section, and all the information is very important. I've also added some of my own screen caps, which further demolish mccainisthroughx's generalized information.
Another question about this explanation would be, were the 1920s really sustainable? If we look at the annualized return in the Dow Jones Industrial Average from April of 1924 to October of 1929, the annualized return in the Dow was 30%. Compare this to the annualized return in the Dow over the entire 20th century and the 12 years of the 21st century. The annualized return is 5%. So is it really reasonable to think that a 6 times as large annualized return in the Dow is really sustainable? Perhaps it's just that investors began to understand in 1929 that these increases in the stock market could not be sustained. Even in periods of fairly rapid economic progress like the 1950s and early 1960s, the annualized return in the Dow was only 12%. In the 1980s and through the 1990s, again another period of substantial economic progress, in the American economy, the annualized return in the Dow was half the return in the Roaring 20s. To find a period of where the annualized return was approaching this 30% rate in the 1920s, you have to go to the boom of the late 1990s. There, the annualized return from January 95 to January 2000 was 25%. And we know also that this period, like the Roaring 20s, was not sustainable, but was followed by a significant stock market crash. It's also true that stock market declines of 50%, which was the initial decline in the Dow in October and November of 1929, were not uncommon. The Dow Jones Industrial Average fell roughly 50% in the time of the Panic of 1907. The Dow also fell 50% in the recession of 1921. There were certainly investors still alive trading in the markets in 1929 who had been through this earlier period just 8 years before. And we're well aware that the Dow could and had in the past fallen 50%, but of course no Great Depression followed either of these earlier 50% declines in the stock market. Even the one-day declines in the Dow Jones Industrial Average have been bigger than the one-day declines in October of 1929. The Dow fell 13% on October 28th, 1929, and 12% the next day on October 29th. But in 1987, the Dow fell 10% in the 3 days before the Black Monday stock market crash on October 19th. And on that day, the Dow had its biggest fall in its history of 23%. And once again, no Great Depression followed these declines in 1987. It's even true that the overall decline of the Dow Jones Industrial Average is not unprecedented in the Great Depression, the decline from 1929 to 1932. There was an 89% fall in the Dow between October of 29 and June of 1932. But there was a 78% fall in NASDAQ during the dot-com bust, starting in March of 2000 and running through October of 2002. The NASDAQ, in fact, has a bigger market capitalization than the Dow having only 30 firms, as we spoke about in our stock market discussion, the NASDAQ covering 3,200 firms traded on the NASDAQ. The Nikkei in Japan fell 82% in its slide after the initial crash in December of 1989. And once again, no Great Depression followed the dot-com bust, and there was not a Great Depression in Japan. One last point about the pessimism argument to explain the Great Depression. The pessimism of investors reversed early in 1930. There was a 48% decline in the Dow from October 1929 to the end of November 1929. But from November 1929 to April of 1930, the Dow increased 43%. So it wasn't this snowballing effect that's claimed in this historical argument. Quite the contrary, investors came roaring back in the early part of 1930 just to see their anticipations of the quick restoration of normalcy in the economy, which had occurred in 1920-21, to be dashed by the interventions of Hoover and then Roosevelt. This is what the Dow Jones Industrial Average looked like from 1920 to 1940. You can see the big buildup after 1924 to the peak of the Dow at 381 in October of 1929, the 50% decline to November, and then the rebound that we just mentioned running into April of 1930. And then as you trace the Dow moving through 1930, 31, 32 to its eventual bottom at 41.22, you can see that it continued this pattern of falling, and then investors coming back into the market and pushing it back up, and then falling, and then rising again, and then falling and rising again. So there wasn't this monolithic snowballing effect of overwhelming pessimism spreading and spreading. Investors keep coming back into the market and driving it up after another round of it declining. Again, this is the effect of their continuing reassessment of their expectations in the face of ever increasing and unpredictable government intervention that's taking place under Hoover. We can also see that the Dow increased very dramatically from the bottom in mid-1932 to its peak in 1937, increasing fivefold in that time. And from 1933, where You can see early in the year it hits 50.16, it corrects back down. This is the period in which Roosevelt takes the United States off the gold standard and unleashes a tremendous monetary inflation on the part of the Federal Reserve, which is responsible for the boosting of the stock market from 50 to 200, the fourfold increase. The market then corrects again, falls 50%, from 200 nearly to 90.95. In 1937, the unemployment rate worsens again from around 14% to almost 20%, and the market does not recover these elevated levels pushed up by monetary policy for the rest of the decade. Now here's the Dow for 1940 through 1960, and we can see that World War II did not bring the economy back to a normalcy, bring the stock market as an indicator of capital accumulation back to its normal economic progress. The market collapsed again from its high of 200 nearly in 1937 to 92.92 in the early part of 1942. We're now into the United States active participation in the war.
Now for our finale, folks. I hope you enjoyed the Herbener video. It was very informative. I urge you to watch the entire thing. It's about a half hour total. It's definitely worth it, and it's better than excuse me, any videos janitors from Chicago will put up. Now that we're done with that, I've got one more issue to cover, and that will conclude this slapdown of the vacuous janitor mccainisthroughx. She totally ignores the 800-ton gorilla in the room, the Federal Reserve. McStupidX, the lone person running the mccainisthroughx channel, never mentions that the Fed is engaging in an unprecedented cheap credit gimmick. Folks like Peter Schiff and George Selgin have been critical of gimmicks like this and been pointing that out for years, and for good reason. Hussein Obama and his cronies like Bernanke and Yellen are just continuing the low interest rate cheap credit gimmick that began in the waning months of the Bush administration. Funny how strange bedfellows there, huh? Bush's Fed also did the same thing, although not for as long, and interest rates didn't plunge as far shortly after 9/11. Since August 1st, 2007, the Federal Reserve's total assets have more than quadrupled. This is also unprecedented. Hussein Obama and the Fed are purposely trying to stimulate this economy, and it's not working when one gazes upon the economic indicators that I covered at the start of this video. Unless accumulating debt is your end game. Don't expect the non-Dr. mccainisthroughx to cover anything like this. She just sees an increase in the Dow, but isn't intelligent enough to discern that it's a mirage. For example, the Federal Reserve, quote, is increasing the long-term risk in our financial system through both its monetary and regulatory policies. It is simultaneously redistributing wealth from moderate income savers to high-income households and laying the foundation for another housing bubble. And I'll add this, yes, Washington is insuring a lot of home loans. They've still got the market cornered there. They're purposely pumping up the housing market again. From 1914 until 2007, the Fed's balance sheet grew to $900 billion. Since 2007, the balance sheet has exploded to $3.2 trillion and is growing $80 billion per month. The Fed's capital ratio is currently 1.3%, while the average capital ratio of the largest banks is 8%. The Fed fails its own stress test and should be forced to shrink by its own standards. The risk in the financial system is not large banks, but the Fed itself. And of course, the Fed, I will also add this, the Fed enables this bailout mentality because it engages in bailing out these banks, and Congress goes along with them on it. Quote, and I'll give you a hint too, bailing out banks didn't start with TARP. That crap. SOPs to big banks have been going on since FDR was in office. Quote, the Fed's balance sheet has been radically expanded to hold down interest rates by buying Treasury and Freddie Fannie bonds. This has significantly expanded the lending capacity of banks. Increasing the level of bank reserves has the same effect as printing money. If the economy starts to grow, either inflation will increase as money velocity accelerates, or the Fed will have to withdraw the excess reserves, which will result in rapidly rising interest rates and major losses for bondholders. If the Fed does not shrink its balance sheet, the economy could be stuck in very slow growth as the government consumes an increasing share of the economy, as has happened in Japan. End quote. In the forgotten depression of 1920, the Federal Reserve, in contrast to today's policies, wielding its dual mandate like a double-edged sword. And since people like making crazy metaphors here, I could liken the Federal Reserve to ISIS or Al-Qaeda with a double-edged sword, just cutting the American people up. That'd be a good analogy. In the forgotten depression of 1920, the Federal Reserve, in contrast to today's policies, wielding its dual mandate like a double-edged sword, didn't get involved to save us all from economic peril 94 years ago. That's a stark contrast to the micromanaged economy we see today. This is not your great-grandfather's economy, or depending on how old you are, your grandfather's economy. Again, all this cheap credit, easy money policy is doing, all it's doing is enabling spenders, including Washington, to accumulate debt. It's a gimmick, it's a mirage, it's BS. This is akin to the stock runs in the 1970s, which turned out to be a ruse, and the run that occurred late in FDR's first term, only to come crashing back down to earth. The scary part is, Washington wasn't quite as involved as it is now. It's quite funny to see mccainisthroughx and folks like her to vote against their own self-interest. When the economy crashes again, poor folks like herself will be less equipped to deal with it than others. Although most people will get undercut in some manner, some worse than others. My last point is to mention how these uber low interest rates are hurting seniors. My father, for example, retired with no debt whatsoever. Unlike a lot of people, he didn't bury himself up to his eyeballs in debt just to make folks think he's rich or accumulate a lot of bling or to get stuff. He didn't buy into the consumerism promoted by Washington, the spend, spend, spend right now philosophy, but these low interest rates are hurting retirees. Those who were responsible, and besides being saddled with the duty of paying for someone else's retirement, someone who is getting a lot more dollar for dollar than they paid in, those folks who have now made it to retirement aren't seeing their savings grow. That concludes this slapdown of the vacuous janitor, mccainisthroughx. She only focuses on popularized material, does short generalized videos that appeal to her sheep, and doesn't like details. Don't thank me now for correcting you, McStupid, and just in case you do watch this, and I know you will, every time you do a Dow video, I'm going to recycle this response. Have a nice day, little fella.